1, with interest rates so volatile on the lump sum, does it make sense to just take an annuity from Chevron? Also, is the annuity insured? So two-part question. With interest rates being volatile, this is only a risk while you are still working at the company and prior to commencing your benefit. Now, interest rates going up is going to probably reduce how attracted you are to the lump sum because it's going to look like a much lower payout. The flip side of that, though, is that you can now go out and buy bonds or fixed income investments, lower risk investments in stocks, and earn more interest than you could have previously. So there's a little bit of give and take there. The reason to take a lump sum versus an annuity is much broader than that. There's a lot of other considerations. We talked about many of them today that we'd encourage you to run a cash flow analysis, do a comparison, talk with myself or one of our Chevron focused advisors so we can point out all of the major considerations and shine some light on what might be a better long-term strategy for you. It turns out that there is insurance through an organization called PBGC, the Pension Benefit Guarantee Corporation. This is a federal institution. When a large company goes out of business, we've seen this many times in the past in the auto industry, in the airline industry. We saw this with a massive company years ago that went out of business recently, Sears Roebuck. The PBGC steps in and insures pensions, but not fully. There's a possibility if Chevron was to go out of business and you were on this annuity payment, you were an annuitant, that you could see a reduction in your lifetime income from Chevron. So while it is a risk, it's probably a lower risk for Chevron compared to many companies that don't have as good of funding on their pension plan and aren't as strong of a company potentially as Chevron, but still a risk that needs to be evaluated nonetheless.